We all want to beat the market. Nobody wants to be that guy to see their portfolio underperform all while the S&P 500 goes up year after year. Nothing is worse than seeing red in your portfolio after years of investing. Everyone is so quick to give you tips on what you should be doing to outperform, but I'm going to give you a list of a few things you should completely avoid if you want to outperform the S&P 500 and the Nasdaq in the long run. Now, the first thing you want to completely avoid when investing is any penny stocks or small caps. Now, when you invest in companies, you want to invest in high quality companies that are growing their intrinsic value and growing their earnings per share and growing their share price. The majority of penny stocks have very poor fundamentals and do not meet any of these requirements for quality investing. Let me just give you an example. So over here, I have a penny stock here that's named Hyperscale Data. And if we go into the fundamentals of this penny stock, you're going to see that these penny stocks, the majority of them, and this is just an example, but the majority of these penny stocks have extremely poor fundamentals. So if you look at insights of this company, you can see that, first of all, it has a very bad rating on my stock platform. But if you look down to the profitability, you're going to see that these companies are actually very unprofitable. So these companies that you're investing your money in, these penny stocks, they don't earn any money in return. They're taking your money and they're basically just throwing it in the garbage because they are literally unprofitable businesses. And when you're a good investor, you understand that companies follow fundamentals. And when companies follow fundamentals, you're going to see that poor fundamentals result in very poor performance. So you want to be investing in companies that you hold for the long term. And you want to have companies in your portfolio that over the next 10, 20 years, they continuously grow in intrinsic value and generate great returns. To give you another example, look at the free cash flow of this company. This free cash flow of this company has been negative ever since basically the start of the company. And when you compare a small cap stock like this to a company like, I like to mention Visa because Visa is such a high quality business. But if you compare a small cap company to a company like Visa, you're going to see a night and day difference. You're going to see how profitable this company is. Like Visa is such a profitable company and it grows its intrinsic value. It grows its price per share. And any investor who invests wants to be invested in a company like Visa. Looking back at this penny stock now, if you go down and you look at the return on invested capital, you're going to see how it's constantly in the negative for the most part. That means that you're giving this company $1 and they're returning a negative percentage on that dollar. You also look at their net margin and it's in the negative too. So you're basically just throwing your money in the garbage investing in these low quality small cap businesses. The next thing you want to avoid is long shots. So long shots could be described as any company that promises to be the next Facebook or the next Microsoft. So in the investing community, I know a lot of people talked about this stock called Lunar or Intuitive Machines. So this company is actually part of space exploration and it specializes in satellites and data transmission. And the reason I mention this company is it's been talked about a lot in the investment community as the next big thing. But I want to pull up the fundamentals of this company and just show you how you should just avoid this company at all costs. So obviously you could see this company is unprofitable. It has no profit. It's losing money. The only thing good about it is its growth. But aside from that, it's still unprofitable and it's still losing money. The return on invested capital is negative. The return on capital employed is negative. And you could also see that they're diluting shareholders a lot by increasing the share count over 200%, which is extremely bad if you're a shareholder. So all around, this company is just very unprofitable. It has very bad fundamentals. And you should just avoid companies like this altogether. The next thing you should completely avoid when investing is turnarounds. You probably all heard the story before. A company is underperforming, it has bad management, but they're going to turn it all around and it's going to be the next big thing. Management is going to get things on track, the profit margins are going to increase, everything's going to be great. That's what they said about PayPal. And over the past 5 years, PayPal has underperformed the market by a significant margin and it lost 75% of its value in the process. If you want to outperform when investing, you have to buy companies that already have extremely strong fundamentals. You buy companies that show a sign of competitive advantage, that show that they could increase their margins and raise prices over the rate of inflation. You have to own solid companies. The problem with turnarounds is you're not actually buying high quality companies to begin with. You're just hoping that in the future, the fundamentals of the company changes. And let me just give you an example of why I disagree with turnarounds for the most part. This is a company here called PayPal Holdings. I know a lot of people in the YouTube community talk about buying PayPal and how it's going to be a turnaround play. So I just want to look at PayPal's fundamentals. And what catches my attention is PayPal actually has a price to earnings ratio of 15.47. So PayPal, a company that's been underperforming the past 5 years, has a PE ratio of 15. But if we look at a company like Google, for example, Google has a PE ratio of 17.5. Now, PE ratio isn't everything, but considering PayPal has a PE ratio of 15 and Google has one of 17.5, it means that you're paying a similar price for Google as you are for PayPal. And if you look at Google's fundamentals, you see that Google's fundamentals are way better than PayPal, and way better by a huge margin. Like, look at these return on invested capital, return on capital employed. Look at these margins. Look at this growth. You're paying slightly more for such a high quality company. So when people say they're buying PayPal in hopes of a turnaround play, I would just tell them to buy Google, because Google is just superior in every way possible. And that's why I think you should just avoid turnarounds altogether. Just buy high quality companies at a good price. The next thing I think you should avoid is just certain industries. So not all industries are equal. And what I mean by that is there's some industries that tend to underperform significantly. And I'm just going to give you a few examples of certain industries that I would completely avoid. The good thing about investing is if you don't want to invest in something, you're not forced to invest in it. And I feel like a lot of industries just shouldn't be invested in just because they're bad industries. They're just very cyclical, where one year they provide a bunch of earnings and the next year they provide negative earnings. That should be avoided. Or some industries just don't make a lot of money. So here I have a list of certain industries I just don't invest in. So you're going to notice that the first one is energy. And the problem I have with energy is it's very cyclical. So you have stocks like Enbridge here. I'm pulling up this stock because it's one I'm familiar with. It's in the energy industry, and you're going to notice that a lot of stocks in the energy sector are very cyclical and they pay extremely high dividends. So you have this company that's paying a 6% dividend yield, and if you look at their earnings don't grow very fast. So they're paying a high dividend, their earnings don't grow very fast, and if you look at the financials here, you're going to see that the return on invested capital and the return on equity are not that high. These companies tend to have a lot of debt, so the debt on these companies is not that great. And again, they're very cyclical, so you could see how the revenue is increasing like 43%, but the reality is the revenue goes up and down year on year, so it's a very cyclical industry. And for that reason, I don't invest in energy at all. I also don't invest in airlines. Even Warren Buffett himself said that he does not invest in airlines just because they're just not great businesses. I have here Air Canada, and this is an airline company. So you could look, you see here, this is kind of funny actually. You look all the way back in 2006, they are at $19 a share. And then all the way up until today's date, they literally returned -3% all time. And this is just one example. And pretty much all airlines are like this. I'm going to just pull up Delta Airlines just to show you an example. So you see here, these companies don't really go anywhere. They just stay stagnant for years. So like if you look at 2015, it was at around $46 a share. And all the way up until now, it's only increased 13% over like 10 years. The performance of airlines is just pretty horrible, and they're not very good companies to be invested in. The same goes for automotives, real estate, and biotech. Automotives, I know a lot of people invest in Tesla. I personally don't invest in Tesla because I feel like it's a very overvalued company. Real estate, a lot of real estate stocks tend to pay a very high dividend yield. I try to personally avoid stocks that pay high yields just because I feel like the performance is not usually as good as a high growth stock, but that's just personal preference. Biotech, I would recommend everyone just avoid biotech. Don't invest in biotech. You won't make money if you invest in biotech, is how I would put it. Now, the next thing you guys should avoid when investing is over diversification. So this is something I see a lot. I see a lot of people that just over diversify their entire portfolio with over 50 stocks, for example. And if you're picking over 50 stocks, you just can't keep up with all your holdings. You're going to have earnings reports that you're going to have to read through, and you're not going to be able to read these earnings reports if you have over 50 holdings, for example. I would argue that even having over 10 holdings is a lot, and I would not be someone who is wanting to put his 11th best idea in my portfolio. I want to obviously invest in my first and second best idea. And when you have over 25 companies or 30 companies, you're basically putting money in a company that's your 25th best idea. And that doesn't sound too good of a strategy, in my opinion. If you want to hold a bunch of companies, then at that point, just buy a high quality index fund like the S&P 500. An index fund would at least guarantee a decent performance over a long period of time. This next one is extremely important, and it's to always avoid trading. I'm just going to go out on a limb here and say that I have never seen a profitable trader in my entire time investing. I've not once seen someone that could actually sit down on a computer and make a trade over a time span of a couple hours to minutes and actually make a bunch of profit consecutively. So I know you're going to see a lot of people like these on YouTube that are going to tell you how you could trade, how you can make a bunch of money trading. And like, there's a bunch of them. Like, look at this. Oh, this is my video. I strongly recommend this video, by the way. I worked hard on it. But there's going to be a lot of people that are going to tell you that you should be trading, right? The only thing trading is doing is getting the people claiming to know how to trade richer, and just engaging in these trading tutorials or paying for courses to trade. It's all just a scam. You're not going to make money. Stick to quality investing, buy high quality businesses, and hold them over the long term. Don't even bother trying to trade to make money. To give you an example, let's just say I'm trading the stock and I predict that it's going to go upwards in the next 5 minutes. Then Donald Trump posts on Twitter that he's increasing the tariffs 200% for every country. The stock would drop like a rock, and I would have no control over predicting what just happened. All that to say, you can't predict the market over such a short time span. The next thing you should avoid is dividends, or better said, buying a stock just for its dividend. There's a lot of people that try to buy stocks for different reasons, but the worst reason to buy stock is just because it has a high dividend yield. Usually stocks paying high dividends have mediocre fundamentals. So I'm just going to give you an example of a company called AT&T. This is a telecom company. So if you look at this company, you're going to make a couple observations. So the first observation is that it has a dividend yield of 4%. There's a lot of investors that will see this dividend yield of 4% and think to themselves the stock's a great buy just because it yields a dividend yield of 4%. But the reality is a lot of stocks yielding high yields like this at around 4% or higher, they actually have very poor fundamentals. So I'm just going to show you the fundamentals of AT&T. And if you look at the financials of AT&T, you can see that this company has literally had no growth all the way back since 2007. So I'm just going to show you this graph here. If you look back in 2007, 2008, you can see that its total revenue was around $118 billion. And looking all the way to now, 2025, their total revenue is $122 billion. So ever since 2007, this company is earning the same earnings as it did back then. And it doesn't stop there. So if we scroll down a bit, you could see that this company has significantly diluted shareholders over time. You could also see that the company has very unpredictable cash flow. So ever since 2009, the cash flow has stayed the same as it is today. All around, this company is just not very good. The only thing good about this company is its 4% dividend yield. But even with the 4% dividend yield, you would still underperform the market significantly. And that's why I really warn these new investors to avoid high dividend yielding stocks, because the majority of the time, these companies are just not very good fundamentally. That's why you're much better off buying a stock like Google, who actually doesn't pay a high dividend yield at this moment. But buying a stock like this that's high quality will yield you a lot higher of a dividend down the line. So maybe Google is only paying a 0.53% dividend at this moment, but down the line, that dividend is going to increase significantly. And over the next 5-10 years, after the share price has doubled or even tripled, you're going to have a dividend yield that's significantly higher. And combine that with dividend increases, you're going to be earning a lot more on this company than you will with a company that's paying a 4% yield like AT&T. And the last thing you should avoid doing is not buying high quality stocks. So this is something that seems obvious at first, but I notice a lot of investors just do not buy high quality stocks, and then they wonder why they're underperforming the major indexes. Just to give you a bit of perspective, if you followed everything I've been saying so far in this video, you will most likely know what a quality stock is. But I'm just going to go back to Google and show you what a quality stock would look like. When I look for companies, I look for companies with strong growth, strong earnings, and pricing power, strong fundamentals, strong margins, strong return on capital, increasing revenues, and low debt. And as you can see here, a company like Google meets all those characteristics. So when I'm analyzing a company, I always look at these characteristics to make sure that the company is high quality. And I can see everything about Google is very high quality. I can see that the shares are decreasing, they're doing strategic buybacks. I can see that the revenue is increasing 13% on the year. I could see that this company has an extremely strong competitive advantage just because the gross margin is almost 60%. That shows that this company could earn a lot higher margins than its competitors. So you always want to look for high quality companies like Google. And what I can't help but notice is a lot of investors just pick low quality companies. And when you look at companies like Google, Visa, Microsoft, MasterCard, and Moody's, all of these companies are such high quality companies, and sometimes they're even trading at very fair prices. And what I see is a lot of investors just completely avoid these companies for no reason whatsoever. So my advice would be to just always buy high quality companies. If you have a portfolio full of extremely high quality companies that you bought at a very fair price, you would outperform in the long run. And that's exactly what I've been doing. I have a portfolio of 9 companies, and these 9 companies are extremely high quality. They're the highest quality companies on the market. And over the past years, I've significantly outperformed the indexes just because I held on to such high quality businesses. And if you avoid the things I told you to avoid in this video, I could almost guarantee that you'll outperform the indexes over the long term. I hope everyone has a great day, and thanks for watching.